Good afternoon, everyone, and welcome to our third quarter investor call. It's one of our unique 90-minute case study-based webinars that we do 4 times a year. And today's webinar is sponsored by NewPoint Real Estate Capital. NewPoint is a prominent commercial real estate finance company delivering lending solutions to investors of multifamily, affordable housing, seniors housing, healthcare, and manufactured housing properties nationwide. It leverages technology, data, capital, and the expertise of its industry-leading team to provide loan origination, servicing, execution, and a suite of agency and curated proprietary products to meet the evolving needs of its borrowers. And I'm also exceedingly pleased to be joined by Eric Lindenauer, who is the president of FHA at NewPoint, overseeing the FHA multifamily and healthcare origination and servicing operations for the firm. Eric was previously the executive chairman of HHC Finance, a top HUD lender that was acquired by NewPoint in 2021. Welcome, Eric. It's been a couple of years since your last webinar with us. Great to have you.
Thank you. Thank you for having us back.
Absolutely. And next, Sarah Anderson joins us from Newmark, where she is a senior managing director responsible for all the seniors housing related debt origination and structured finance in the U.S. In her more than 14 years of experience, she has been involved in more than $10 billion of real estate equity and financings for major institutional and private owners. And I know she's working on some substantial volume right now. So it's great to have you today, Sarah.
Thanks, Ben.
And we also have James Scribner, who brings a host of experiences and perspectives to the panel today. He's worked at H.J. Sims, Red Capital Group, and Hunt Real Estate Capital before founding Scribner Capital in 2020, where he now offers various investment strategies, including joint ventures, mezz debt, rescue capital, distressed asset purchases, plus co-GP capital to growing operating partners. So he can speak to us both as a lender and as a buyer, and very happy you could join us today, James. Welcome.
Thanks, Ben. Happy to be here.
All right. Well, most of our conversation is going to center around the lender's perspective today, what different lenders and capital providers want to do in the next 12 months in terms of volume, deal structures, terms, growth strategies, and also who they want to work with. And with well over 300 registrants to the call, clearly there's a lot of interest in the topic. And my esteemed panelists will present several case studies and data from actual transactions that they've closed recently that are really emblematic of the current lending environment, both closed and transactions they're working on right now. We'll also be covering how the lending will change in a lower interest rate environment, hopefully, so that prospective borrowers can prepare and adjust their M&A, development, and refinance strategies for 2026 and beyond. So if anyone in the audience has any questions along those lines, they could enter them in the Q&A box in the Zoom window. Also, at the end of the call, a survey will appear, and all of your responses are greatly appreciated. We use them to improve our future broadcasts, also inform our future topics. So thank you in advance for that. And finally, if anyone is interested in sponsoring one of these webinars, spots are running out for our 2026 calendar. So please reach out to me if you are interested in one of those. And of course, thank you very much to NewPoint for sponsoring today's webinar. So without further ado, given all the moves that Frank Cassidy and HUD has made this year and its record-breaking fiscal year in the lien program, Eric, what do you think HUD wants to do in fiscal year 26, and how will that impact borrowers? I pulled up your first case study slide as well, so feel free to transition to that whenever you want.
Thanks. I think, speaking on behalf of myself and everyone else in the HUD industry, we're delighted to have Frank come in as a new leader at HUD, because he's been on the lending side for a long time, so he understands the complexities and the importance of the relationship between lender and the FHA or HUD. And because he has that bridge and that connectivity, it's just he knows kind of what the log jams are, and he's been great. I mean, as you know, we talked earlier about how he instituted the express lane, right, where we actually got a deal done from submission to commitment in 3 days, which was his goal on that.
And you
Uh,
guys were that record
yeah,
then.
so we were the first ones. Then there are others behind us. We're not necessarily the best, but we actually had a deal that qualified and worked. And it's true. It was unbelievable, and the bars were blown away. He changed on the multifamily side. He knocked the MIP to 25 basis points straight across the board, which is a huge help. And on sub rehab, he basically got rid of. There used to be a requirement that you had to, if you did two major systems like AC or electrical and plumbing, it automatically triggered a sub rehab. And he got rid of that. And before it was that you were allowed to build up to 15% of renovations of the appraised value into your loan, and he upped that to 25%. So, you can close on now a HUD loan and 25%, take 25% of the value and do improvements, nurses stations, windows, PTAC units, on, and it does not trigger a sub rehab. So, we think it's great. And he has some more, I know he's got some more stuff coming down the pike. And listen, they have a whole committed team of people. They're great people. They have to work within the confines of federal guidelines and regulations, which again, Frank is trying to loosen some of that. And I think he would love to see, 25% higher volume than this last fiscal year. Although, HUD's fiscal year ends September 30th. So we've already lost one of the 12 months to the government shutdown. So we'll see how the year winds up.
Oh yeah, they make that very clear on the HUD website when you go there.
Absolutely. Gotta love that.
And so, Eric, do you want to kind of transition that
Yes.
into this case study that you have here?
Yeah. So we did, there's no such thing as a standard HUD type HUD loan, right? They all have and HUD is more of an art than a science, but you have to stay within the guardrails. So we had a case this year, which we recently closed on. There were two assisted living facilities on the West Coast. And as you can see, the borrower had financing from a bank located in the Midwest. It was pre-COVID. And like many assisted living facilities and other seniors housing places, got really hurt during COVID. And the federal government had these special programs through the SBA. One was an EIDL loan, and they had some other types of help with subsidies. But the borrower was able to secure a loan from the SBA as a second behind the bank loan, and it had fantastic terms. I think like 3% fixed for 30 or 35 years. Very, very attractive. And the homes turned, they stabilized, they qualified and went to HUD. And the first shot out of the gate was, HUD doesn't allow secondary financing. They're going to want us to retire the SBA loans. The borrower, obviously, he said, why, this is fantastic financing. It's actually better than HUD's financing, and the rates are locked in at 3%. HUD was whatever, 5.5% at the time, plus the MIP. And, so it took 8 months of negotiating back and forth. And we basically compared it for HUD. We said, look, this is no different than having AR financing, right? You allow AR, you allow that as we have an intercreditor agreement. We had to walk them through that this was actually better for the insurance fund because let's say the SBA loans were $1 million, right? That's $1 million less exposure, and the debt service coverage on that is going to be higher, meaning the debt service on that $1 million with the SBA, that monthly payment is going to be lower than the one that they would have to make to HUD, which puts the borrower in a better and a healthier situation. We also had to get the SBA on board because they weren't crazy about it. And having two federal agencies work together is sometimes, while they're each very good at what they do, trying to merge two programs is sometimes like oil and water, doesn't necessarily mix. We got HUD to agree to one thing, the SBA to agree to another. And finally, the SBA said, look, we'll allow this to go through, but they wanted a pay down of, I think it was like 10% of their loan. And finally we closed. So that was, it was fascinating and interesting. And the HUD team did a great job, especially their legal, that really had to put a lot of extra work into this.
Yeah. So I guess why did HUD agree to this? Was it because that the borrower's in a better position going forward with the SBA loan, or did they see any other positives to this? And maybe can other borrowers expect a similar negotiation for any other situations they're in?
So I'll start with the latter question first. I would say, the most important thing is ask the question, right? If you're a borrower out there and you have a unique situation, speak to your lender about it and, get organized. And it's all in how you ask the question, right? And how you present the facts. And why did HUD agree to it? I think that when they took a step back, they realized, hey, this is actually good for the borrower. It's better for the project and it's better for the residents, and it's going to generate more cash flow, which, in turn could mean better, more staffing, just a better overall environment if the borrower actually puts the extra monies back into the facilities. You don't see that all the time, but there are some borrowers that absolutely follow that stance. And we also explained, hey, this is less risk to HUD, right? You're insuring less money. It's a second mortgage. They're behind you, and the SBA got on board because they realized that their loan is below market, so they asked for a pay down of some of their loan, which was all agreed upon.
Do you get the sense that HUD is at all more flexible these days compared to maybe a year ago?
Uh, I think the current working group at HUD is very pro-business and they want to figure out ways to get deals done versus, 4 or 5 years ago when, it was, the first response was always no, right? Because that's the easy thing to say, no. But this working group under, Jen and Tim and some of the other folks there, a lot of great people, they want to figure out ways to get deals done, which is refreshing. They're really a partner with that.
You get the sense that they're almost unleashed to do what they're supposed to do, which is put out loans.
Yeah, absolutely. And I know what you mean by unleashed, but not in a reckless way, right?
Yes.
Uh, they still have, we still have our the CFRs, that the Code of Federal Regulations that we have to follow. But as long as, we have to look, is this a HUD notice or is this in the CFRs? If it's a notice, maybe we could change something. And what does it change like? And like when they came out with the whole lean program, they modified some things and came out with notices on that. And I think if something makes sense, they will absolutely be in support of that, as long as you have a good borrower and you're a prudent lender and you do your homework.
Yeah. James and Sarah, if you, unless you have any questions for Eric on the case study or on HUD, we could move on to Fannie Freddie. Good with that?
Sure.
Yep.
All right, so Sarah, I'm going to go to you next. So with Fannie and Freddie, what do you think they want to do as far as originations for next year?
Sure, yeah. And I think really to address that, it's important to talk about what we've seen from them really this year. And I think, because I think, both have gone through kind of their unique challenges, have emerged from that in different ways and taken different views on credit policy and whatnot. But I do feel like we're in a really good spot with both lenders. So I guess I'll start with Freddie Mac's. I mean, I sit on the Freddie Mac Advisory Council for Seniors Housing, and they're continually getting feedback from us and looking for ways to improve their terms. How can they be more responsive? How can they meet the timing guidance that we give them, et cetera? Freddie Mac, I know, is having a fantastic year from an origination standpoint. I think they're set to hit their cap this year as an overall sort of multifamily conglomerate, but specific to seniors housing. They had I believe, a $2 billion plus or minus goal for volume, and they will exceed that this year. They generally are conservative in their goals. I think next year they'll probably have at or around, if not a little higher than 2 billion. And I expect that they'll surpass that. I mean, the amount of volume in particular as it relates to larger portfolios where both, from an acquisition and refinance perspective, there's been a lot of increased activity, certainly towards like this summer and like into the second half of this year, way more so than all of last year. So, as deals continue to underwrite and volume goes up, I feel like they'll kind of continue to, increase activity. Seniors housing does have generally a strong mission-driven score, which is important for Freddie Mac and Fannie Mae. They've been very aggressive on both fixed and floating rate quotes. I think, the percentage of fixed to float has been about 80-20. And I think that pre-interest rate increases was more like 50-50. So I think probably next year you'll continue to see an increased appetite from borrowers looking for floating rate loans from Freddie Mac. And they've sharpened their pencil on underwriting, and they have the ability to go up to 75% leverage if the debt service coverage is there. So I think that they'll just continue to be a great provider of liquidity for permanent financing. Moving to Fannie Mae, I'm no secret that they've been a little bit sidelined from seniors housing. They kind of took a step back and really focused inward on, the portfolio that they were managing. In terms of volume, they generally have similar goals to Freddie Mac in that they're at or around $2 billion. I don't believe that they'll hit that this year. Next year, they're hoping to be a little bit more aggressive. Fannie overall has gone through some reorganization and coverage for seniors housing, but now, I mean, we had a call with the head of Fannie Mae multifamily a couple of weeks ago. The head of credit for all multifamily was on that call as well, really just to hear what we're seeing in seniors housing. And I know that they're having similar conversations with our peers as well as borrowers, just to really wrap their arms around what is the market looking for from them, where can they be most competitive. Fannie Mae's credit facility product is extremely interesting to borrowers, gives our borrowers a ton of flexibility, in particular for large portfolios. They weren't quoting SARMs, which is their floating rate product, and now they are. So they're really evaluating ways to be more competitive, and I think that we should expect to see more from Fannie Mae next year as well.
What is changing at Fannie Mae that is leading them to want to do more in seniors?
It's what we're seeing across all the industry, right? There's increased demand from their borrowers. I mean, their top borrowers in multifamily and other asset classes are asking them to, step back in. Their mandate is to provide liquidity, but obviously also, protect downside from a credit standpoint. So I think it's really, they're trying to be there for borrowers and just figuring out where the best place for them to be will be.
And do you see them getting more competitive with each other and also with other lenders in 2026 on terms or possibly leverage or anything else?
Certainly. I mean, Fannie's always been, Fannie and Freddie are always very competitive from a longer term fixed rate execution. Freddie's generally been the winner on floaters over Fannie. And, like I said, the credit facility product with Fannie is super interesting. And I think Freddie's trying to come out with something similar. So but they're both seeing increased competition from banks as well as life companies and even debt funds in some scenarios. So they're very receptive to market feedback in order to make sure that they're being as competitive as they need to be to win the business. So again, that responsiveness and has been an improvement and a change that we've seen from both groups this year that bodes well for borrowers.
That's good to hear. James, Eric, any questions for Sarah on Fannie or Freddie?
Yeah, Ben, that was going to be my question, is how much are Fannie and Freddie competing with each other versus competing with life cos? I know there's some new life cos in the space, and we're seeing banks quoting 5-year with extension, 7-year type loans. So I'd be curious, kind of, is it mostly with each other, or are they getting, like you said, some debt funds? That sounds a little expensive, probably relative to Fannie Freddie, but
Yeah, it depends on the motivation or hot button for the borrower. I mean, the clear benefit to an agency loan is no ongoing operating covenants. There are no ongoing minimum DSCRs or debt yields, which is, I mean, we've structured something somewhat similar with the bank recently on a portfolio, but I would say for the most part, banks are just simply not equipped to do that. They have to have, what maybe they'll give you a 12-month holiday on a covenant test, but the reality is that they still have to have them in the structure. So certainly from a leverage and pricing standpoint, the banks are competitive, but then they might lose on structure. The life insurance companies, which I know we're going to talk about in a little bit, they're less sensitive to like the formula to get to min DSCR. So maybe they can be more competitive on leverage, but the same on pricing and generally don't have ongoing operating covenants. So they're competing against one another, certainly, but there's so much liquidity. I mean, there's a ton of liquidity for seniors housing debt right now, which I know is the whole purpose of this conversation. So they're getting a run for their money on certain deals that we have had out this year.
Good. Eric, we did get an audience question, and I know you kind of briefly touched on this, but understanding the pro-business approach Frank and the team at HUD are making, it seems like HUD's ability to bend and amend seems case by case. Will the bends and amends ultimately make it into the HUD guide?
Do I have to rhyme my answer? Bends and amends.
Yes.
Uh, so what HUD does is they have something called a frequently asked question bulletin, and that is kind of updated, and you can go back, and when they agree to do something, it gets posted on there, their answer. And so you can kind of reference, and I think it's public. I mean, I know all the lenders have access to it, so I think it's fairly public. So the borrowers and the anybody who wants to access it can. So and they can't. HUD does not play favorites, right? They may be willing to try something with one lender first if that lender brings it, but once they agree to it with one lender or borrower, then it's a standard going forward. I don't know if that answers your question. So whether or not it officially makes it into a notice or the guide, they every time they change the map guide and the lien guide, it's almost literally an act of Congress, right? They have to update it, then it has to go to OMB for review, and it takes years and years. So the quicker way to do it is have these scrolling, frequently asked questions and HUD notices, which are a lot easier to do. So if someone's interested to see if something's been done, that's what I recommend they do.
Well, we'll either get a nice or a nasty rhyme back from that audience member if you answered
There
his
you
question,
go.
but I think you did. And Eric, you got another question. How difficult was it to work with the SBA on negotiating the HUD surplus cash flow note language?
I actually think they were harder than HUD. And what they actually did is they agreed at one point to everything, and we drafted all the documents. And then someone else came in and took over and basically shut all that down and said, we're not doing this. This person's wrong. And they really, they were a lot more challenging. They kept moving the goalposts.
All right, so look out for that. James, so much of the buzz at Nick and the positivity at Nick surrounded the banks coming back, and also how quickly it seemed that rates were coming down, spreads were coming down, prices were going up for assets as a result. Can you just tell me what changed this summer with the banks?
Yeah, no, that's a good question. I think it's not one specific thing that you can pinpoint. And I'm not sure it happened this summer. I think it's sort of the convergence of things that happened over the course of the last 12 months, 18 months. I think first and foremost for the lenders that have historically been in the space, some that continue to be active, but cautious, others that pulled back altogether. I think the primary thing is their lending book improved, right? And so they were under a tremendous amount of pressure by the regulators. Interest rates had gone up. Floating rate debt. A lot of these books were floating rate loans. We're looking at buildings that were losing money operationally, that were not covering debt service, even ones that were doing well, because interest rates had gone up so much, we're not able to cover debt service. So, really the fact that the lenders' overall books had improved, I think is the primary thing, right? We had occupancy pick up tremendously, right? Buildings that leased up. We had large rent bumps, right? Even when occupancy was low, they were able to push rents through. So really good revenue growth. The labor situation subsided, right? Certainly on the senior housing side, I think the skilled nursing side had a lot of support, obviously from the federal government. Private pay senior housing didn't have nearly that support, but you had labor through the roof, overtime, temp, wages going, escalating, just trying to compete and get people in to work. So, as those metrics improved, it allowed these lenders, to sort of be in a position to lend again, where they were on the sideline. For a period of time, lenders that were out there were only lending to existing customers, only lending to people that, best in class, right? That they had really good experiences with. So, the second thing that happened is trade started to happen last year, right? As interest rates started to come down, we started to see real trading activity of stabilized assets. I think there was a window of time where it seemed like nothing stabilized traded. And so it's really hard for people to get their arms around, hey, where are we going here? Are we going back to 7 cap, for good quality assets, or are we going to be at 8 cap, 9 cap? And everything that was trading seemed distressed. The appraisals, we were seeing them come back and trying to, I think at the end of the day, I'll give the appraisers some credit. Numbers that we thought might have been a little higher than we thought an asset might be worth probably proved out to be true ultimately, certainly for high quality assets. The other part of this is, as their books improved, the lenders' books shrunk, right? So one was they wanted to get certain assets off their books. They worked with those borrowers to make sure that happened. Simultaneously, a lot of deals were refinanced away from them, either to other banks or were sold, just in due course. And I was talking to one lender, they might experience a 10 to 15% runoff in their book, because nothing was really coming off their books for several years. They're closer to 30% or more of runoff. So, you've got additional runoff in their books. Plus they've got a mandate to grow their books, right? As 2024 going into 2025, hey, now we need to grow these books. We need to deploy more capital. That puts a lot of pressure on them. And so I think the convergence of those things, and there's other factors, right? There's a number of other factors in commercial real estate largely, where I think senior housing, healthcare, obviously for a period of time, we're certainly very concerned, have proven themselves to be resilient, proven themselves to be need-based. And so money that's coming away from hospitality, money that's maybe coming away from, office, right, needs to be deployed somewhere. I think also C&A lending has been tougher for banks, right? Typically that's very treated very favorably. But with what's going on in the credit markets today, right? And they're not able to deploy money there, right? So now there's a flow of funds also into senior housing. So I think, those are a number of reasons why, the lenders that have been in the space historically really got active into this year. And then you combine that with new entrants, right? And people that had pulled out that came back. So now you've got, even more supply on the lending side. So I'd say right now it's a very borrower friendly environment. I would say in some cases, Sarah can chime in. I would say we're at historically low spreads for the banks. I mean, we're talking, we haven't borrowed under 200 yet, but we know for stable assets and institutional quality Class A assets, you're talking spreads under 200. We're going to have a slide here in a couple of minutes. we've closed deals in the mid 200s. So SOFR plus 250, 240, 260 for non-recourse debt. So those spreads were 100 basis points, 150 basis points higher just a couple of years ago.
Sarah, is that like from pure competitiveness among the banks to get these deals?
It is, yeah. I mean, it seems like from the spring to early fall, pricing dropped 50 to 75 basis points in some cases. I mean, it was quick and it happened. It, was all in the favor of the borrower. We have not seen like consistent high 100 spreads to James's point, but I do feel like that could very well be where this is headed. I think especially it just depends on the deal, right? If it's a bank that's motivated to maybe, capture an agency exit or a HUD exit where there's another fee coming to them and call it, 12 to 24 months, then they're more likely to compress their spread into that high 100s. But, overall for most of the money center and regional banks, we're still seeing pricing in like the low 200s.
Well, James, you put together this great slide that shows the evolution in pricing over the last couple of years. So want to take it away here?
Yeah, I would love to. So just highlighting a few things. So these are transactions that we've closed and are in the process of closing. And, I'll just sort of point out, we are value add oriented investors, right? So we're not buying, stable deals. We're not buying cap rate deals. And as a result of that, right, we rely on the banks, right? We're not eligible really for Fannie Freddie out of the gate. And so here are a couple examples. So this is a deal. This was in 2023. We closed. We hired a broker to help us because it was a important seller that we were working with. We wanted to make sure we got the best execution in the market. We got one term sheet effectively. Maybe we got a second one, but in the only term sheet we got, right, this had, coverage in place, right? Real cash flow was like 80, low 80% occupancy. We could not find non-recourse debt. We don't sign recourse, so our partner has to take on that onus. But that's where the market was. Spread was wide. Leverage was okay, but you had to have recourse to even get interest at that level. So, moving forward, we closed on another transaction. We were able to get non-recourse. Spread as a result was a little bit wider, and leverage was lower. But as we got into this year, going back to Sarah's point, in the mid twos, low twos, we just closed on a refinancing. I would say these were pretty much stabilized. It was a portfolio too that were recently stabilized, but a decent history. And you could see the reaction in the market, right? The bank was very aggressive. We were really happy with the execution. We had some good interest only as part of that. We had 4 years of term plus an extension. And then we're working on something right now that's, we're trying to close by the end of the year. Non-recourse, again, sort of in that mid 80s, not stabilized, not a lot of history, but there's cash flow there, right? And so in this particular case, we did not use a broker. We had several debt options. We chose one, that we had worked with before because, there's a bit of time is of the essence. But I think the takeaway here is, the combination of SOFR coming down, spreads coming down, covenants being borrower friendly. You're going from a kind of cost of capital in the 8s, 8.5, 9 range to now getting below 7, and probably headed below 6.5 here in pretty short order.
For that most recent acquisition, did you choose among banks or did you have other debt providers that you were choosing from?
We chose banks just because cost of capital, right? We were not going to see a debt fund. I don't know, Sarah might correct me and tell me she's got a dozen of them that would love to lend at 270 over. But there were a couple of debt funds that expressed interest at a higher leverage point. But again, to sort of where we talked about earlier and Eric's point, like, we want to get money out the door. We're not highly leveraged buyers. We'd rather have the right loan with the right terms at at an interest rate that is, consistent with our underwriting or better.
Eric and Sarah, any questions for James on any of these?
No, and I mean, I think that too, I know for confidentiality to include the size of the loan. I mean, there's definitely still a difference in pricing and structure from the regionals to the larger money center banks. So I think, that when you were commenting, James, on debt funds, like there are certainly debt funds that are pricing like 250 to 300, but again, that's for like a $200+ million loan versus likely, something, a single asset, something smaller.
Yeah, these are all in the sort of $20 to $40 million range. So,
Yeah, right in the sweet spot.
yeah.
Well, one thing that I keep hearing from the banks that I'm speaking to is that, they only want to work with the best in class operators. So this is more of a general question because, James, I know you only partner with the best in class operators. But what if you were somehow self-aware enough that you weren't one of those best in class operators? Can you still work with a bank? And if you can, how do you find them?
Sarah, I'll let you.
I'll take that. I mean, I think it's somewhat binary. I mean, if you're perceived maybe as a like less desirable operator, then there's probably a reason for that. I mean, I don't know. I think that track record in our industry is so important. We have such a small industry here, and if there's a bank that doesn't want to work with someone, it's probably because of an experience that they had with that group. I wouldn't say though that maybe it's a pricing discussion because they've perceived the credit risk to be higher, so maybe they'll be lower leverage or higher priced. But for some banks, it's just, oh, we've had a bad experience, we're a pass. I don't think we don't have any bad eggs that we've seen that just like are not financeable in our industry. I think, especially with how hard all the operators have worked over the last several years to get us back from COVID, like we don't come across that issue very often, Ben.
Yeah, Ben, I probably reframe the question a little bit as maybe, as opposed to best burgeoning operators, right? Smaller operators, growing operators that are, maybe spun out of a larger operator, building a platform. And, for those guys, it's hard, right? They're usually not terribly well capitalized, and I would say, partnering with experienced equity partners goes a long way, right? If you're one of those newer operators or even been around a few years and you're trying to grow into more of an owner operator and you partner with a, multifamily type of fund, right? Like I think they're going to have a tough time accessing the bank world unless they really lower their leverage or sign recourse. If they want to get sort of market terms, I think they need to find a way to work with industry folks, funds that have a portfolio, right? That they can kind of leverage off together and say, hey, here's the operator and their portfolio. Yeah, they don't own any buildings yet, but this will be their first one. But the owner, the equity, the LP, in my case, sometimes the co-GP, right? Here's their history, here's their portfolio, here's their REO. So I would say that's probably the best way to, for those type of operators to access debt.
I would also say, there are certain lenders that, banks aren't their best exit for because they're not qualifying. And that's when you expand and talk to commercial lenders. We will at New Point, talk to borrowers who are, worked for a larger regional and now are going out and starting on their own. Obviously, we're not going to be in the 200 over SOFR range. We're going to be price adjusted. We're going to be recourse adjusted. Recourse could burn off, but this is really an art and not a science. But there are, I'd say if it doesn't fit for the bank, talk to a commercial lender. And a lot of times, a lot of these people won't qualify, and Sarah could touch on this a little more, with the agencies, with Fannie or Freddie, but they may qualify for HUD because HUD doesn't have such as strict of a requirement and for who their borrowers are. I mean, obviously there are certain requirements with experience and so on, but they will finance secondary markets versus primary markets. So they were built on financing and providing liquidity to mom and pops, right? Not the big institutions. Whereas Fannie and Freddie, I think
Yeah,
they're looking for more institutional borrowers and less the 3 to 5 size home size operators.
that's right.
And then for New Point's balance sheet, Eric, what do you, I guess, what's the mandate for that in the next 12 months? What kind of deals are you looking to do there?
So we just rolled, obviously we're just, as people know or may not, we were acquired in July by Benefit Street, which is a part of Franklin Templeton. And Benefit Street is a publicly traded mortgage REIT. So they have a mandate to make loans, make balance sheet loans. And I hope I'm not wrong on this. I think it's about $5 or $6 billion that they have out. And they've been fantastic for us at New Point. And starting, we closed, I think, July 1. And, that afternoon, the guys at Benefit Street said, you got $500 million to deploy, and please deploy it responsibly, but as soon as possible, because we have another $1 billion to go right behind it. And, so we have a mandate to put out money. Obviously, we got to be smart about it. But at least in our space, in the last 3 or 4 months, we've looked at maybe $1.5 billion of deals easily, and we have about 100-ish million signed up. So as they say, hey guys, I have 100 million to signed up. Only 900 million to go.
What a problem to have.
Yeah, exactly, exactly.
Well, that's great. And how will those terms compare with the banks, just generally speaking?
So look, we are not a bank, right? We do have a lot more flexibility. We're not going to lose on proceeds. We're not going to be the best pricing. Although, we are able to get fairly aggressive. I was surprised we had a lower leverage portfolio, which was an exercise of an option. And we were inside 300, we're in the 200 range, and this is high twos. But most likely we're going to be in the, mid threes to mid fours. In terms of leverage, we'll go up to 85, sometimes 90% loan to cost. Obviously, when you're at that level, you have to do kind of a blend of a first and a mezz, and we're going to be in the high 400 range at that structure. And, we like recourse for sure on the skilled nursing side. We prefer recourse on the seniors housing assisted. It's not really market, right? So we won't get it most of the time. We'll ask for it. It's all about structuring it. And, we're not regulated. We don't need to hold deposits. Banks often want deposits and they require that. So we offer a lot more flexibility. And one thing that's important for us is that we want to make sure that any loan that we write on the bridge side, like Sarah had touched on earlier, has the qualifies and for either HUD or Fannie or Freddie, so that we can recycle that loan into an agency or a HUD loan and keep that loan in our portfolio.
Got it. And do you have a rough idea of what percentage of loans you want to go to skilled nursing facilities versus seniors?
So I'm a skilled guy, and that's just seems to be the world that I live in. So, like our HUD portfolio is probably, 90% skilled, maybe even 95% skilled. We have a few, the case study is funny. Like the case study I showed you was an ALF, right? But really, we're a skilled nursing lender. Seniors housing, I'm a HUD guy, right? I'm not a Fannie or Freddie guy. Seniors housing falls into kind of no man's land within HUD for independent living, and it doesn't really qualify for, it's hard to fit in on the 232 side and the multi side. Memory care AL fits great. So we'd love to expand into more into that world, but most of our clients happen to be in the skilled space.
Got it. Well, anyone they,
Which of course is why our pricing tends to be higher, because your pricing on the skill side is higher than on the AL and memory care.
well, if anyone in the audience has any questions about New Point's balance sheet program, you can find Eric's email in the slides, which I have posted to the chat. You can also find James's and Sarah's emails there too, as well as mine. So the audience can find those slides in the chat. Sarah, for the life cos, we heard a lot at Nick that they were coming back to the market, including some new names.
Yeah,
Is that all true?
that is true. That is true.
What's bringing them back?
I mean, I think it's really demand from borrowers, seniors housing investors, more institutional investors have gotten into our space. They're focused on it. They're writing white papers. They're approaching all of their lenders and other asset classes and saying, "Hey, we're going to get into seniors housing. Come with us." I think overall, I mean, you look at like the structure of a life company loan, which is very similar to Fannie and Freddie. It's generally, they typically, insurance companies are grading commercial mortgages on a scale. I think it runs from like 1 to 6. And so life companies in our space are certainly focused on higher quality, moderate to little risk seniors housing opportunities that's generally like a CM2 rating or above. So that's typically 70% leverage, DSCR at or above a 125, debt yields above a 9. So they're not going to come in and take on any kind of ultra risky positions. And that's not what they're built for, right? They're trying to align their mortgages with the longer term insurance liabilities. So, yeah, I mean, there's one group that's new to seniors housing. They had 0 volume in seniors at the start of the year, and I think they're now up to $1.2 billion plus or minus. So it's very real. We're seeing them show up, and like I said, on these higher quality financing assignments. Larger loan sizes are always better for them. IL memory certainly helps for better or worse. Just having IL in the mix of acuity is important to them. So yeah, this is a slide that just gives a kind of a flavor for recent winning quotes on either single assets or portfolios that we've signed up and closed or are in closing on. As you can see, that statement that I made on floating rate spreads comfortably in the low 200s. Leverage anywhere from kind of 65 up to 70%. I mentioned earlier, Fannie and Freddie are comfortable going to 70 to 75%. The life companies typically are going to top out around 65, maybe slightly above 65. But in general, you're looking at fixed rate pricing around mid 5, 5.5, maybe inside of that with a buy down, and floating rate spreads over SOFR in the low 200s. And SOFR, if you look at the curve, we're already below 4% on term SOFR, and if you believe the curve will be closer to mid to low 3s next year. So all in cost of floating rate borrowing is continues to improve as well.
So if I'm a borrower and I'm considering either Fannie, Freddie, or the Life Co, why would I choose a Life Co? Is it just that? Is it just or why would I choose Fannie, Freddie? Is it just leverage or?
All three lenders will have covenants required for closing, whether that's an occupancy, a min DSCR, a minimum collection, something like that. For the most part, none of them will have ongoing operating covenants, so your quality of life post-close is really good. I'd say where we've seen the differential is that life companies, if they can really wrap their arms around the ask and feel really good about the borrower, the asset, et cetera, they're less stringent on their underwriting criteria just to get to the proceeds ask. So if a borrower is looking for 65% leverage, they're paying maybe, somewhere in the neighborhood of a low to mid 6 cap for the asset. There's a chance that that's going to be DSCR constrained by Fannie and Freddie based on the way that they have to tweak the NOI that they arrive at for sizing. And, life code generally can maybe look through that as long as the debt yield is there and they believe in the story. So whereas like on one loan, Fannie and Freddie might land at 62% leverage, but a life company is at 65 with similar pricing. That's generally where we're seeing them beat out the agencies more often than not.
And are you seeing any other life cos that have never done seniors before that are likely to come in the next 12 months?
I think we're going to start to see more. Yes. I mean, like, it's kind of active adult is their entry point, and then they get comfortable with independent living. And then, again, as more of their borrowers ask them to come into seniors housing, we've had a lot of discussions with different life companies who interestingly have entered first in the equity side of seniors housing that are now, talking to their debt teams and origination teams about doing more in on the debt side. I sometimes think that's counterintuitive. If it were me, I would want to be like, 65% right as opposed to 100%, but that's up for debate. But yeah, that's been the trend is life companies investing through various vehicles on the equity side, and then the debt follows suit. So I think we'll expect to see at least maybe 2, if not 3 more life companies in our market within the next year.
And what does this all mean, the increased liquidity from life cos, from more competitive, Fannie Freddie and HUD? What does this all mean for M&A strategies? Like, could we have more owners of the Class A stabilized buildings decide to come to market because they know that borrowers have these better financing options and can afford to pay higher prices?
Absolutely. I mean, we were advising a client earlier this year that wanted to go to market with a very large portfolio. And honestly, last year and frankly, in first quarter of this year, we said, A, we don't know whether the equity is going to be comfortable with that large of a check size. And B, we don't know whether lenders are there for a large portfolio. So I do think that now you've got really a solution across the spectrum of, a $20 million, a $5 million loan up to, we're closing a $1.2 billion portfolio financing later this year. So I think it certainly is injecting liquidity across every kind of risk profile and deal size. So we've seen a huge uptick in M&A and sales volume this year, and I don't see it slowing down per se.
Well, I know that a couple of years ago, it was both liquidity, but also disparate operating performances of many communities across portfolios that was inhibiting any portfolio sales. Now, with more consistent operations, is liquidity holding back any property sales at all compared to, let's say, pre-COVID?
I think that's still the hardest deal profile to capitalize are the like heavy value add and an asset that's currently have negative NOI, and you need to change your operator. You might need to inject some CapEx. I still think that that's a challenging profile because, debt is going to be pretty expensive for that. So for the most part, those typically are either all cash buyers or groups that just have to get comfortable with either very low leverage recourse bank debt or very expensive non-recourse debt fund financing. But aside from that, I think, especially in the case of portfolios where maybe you've got certain assets outperforming others, the creativity amongst, maybe a life company also has a pocket of debt fund, more bridge capability. In that scenario, they'd be able to finance all of it themselves as opposed to maybe, sending a portion of it to Freddie Mac and then another portion of it to a bank. We recently had that situation where there was 2 stabilized assets in a portfolio and one that was in the 70s occupancy. And we were actually super surprised and pleasantly surprised that Freddie Mac quoted all of it together. So without any like crazy steps around performance on the deal that was in lease up. So I do think that.
And when did that happen? Sorry, Sarah.
When did that quote?
Yeah,
Like 3 weeks ago.
okay, that's good
Yeah.
to hear.
Yep. So lenders are
but-
trying to get creative and find, ways to solve for the right deals.
Yeah, great. Yeah. Lead to more M&A activity, which we like. We got a couple of audience questions. One is the kind of flip side of the conversation we were just having. Can you speak to more financing of availability or capital sources and terms and pricing for sub $10 million loan amounts? So anyone can take that.
Yeah, I can chime in. We're in the process of closing on two assets in the southeast, smaller assets. We own a couple down there. We're adding to that portfolio. We got several kind of smaller regional banks to provide us terms on that. We ended up getting sort of attractive non-recourse financing. We could have gotten, if we were willing to do recourse, there were a number of options out there at higher leverage, at lower spread. We ultimately chose a non-recourse loan with 5 years of term. That was a sub 300 spread with the option to do it as either fixed or floating. So either fixed off the 5-year treasury or floating off SOFR. And like I said, a couple of years of interest only. So, there are regional banks and smaller banks out there that are willing to lend. Most of them require recourse, to be honest. I think we had because we had a couple of assets that were very similar in those markets. These assets were stable and cash flowing. The assets we owned compared extremely well to our business plan, and so we were able to get a couple of non-recourse options as part of that.
Yeah, I would second that. It's going to be hard to get a national bank or a national commercial lender to do a $7 million loan. The issuance costs just on legal alone are going to be very, very high. And like James said, your best bet is finding a local bank. You give them your deposits, and you might have to go 50 to 100% recourse or something like that, but you're going to get the best deal and you're going to have a good relationship with them.
Do you have to work with a broker to find those local banking relationships, or can you do the legwork yourself?
You should call Sarah and Newmark, and they get you out. But sometimes it's just like who's in your town, who's in your city, who's in the general MSA, and you tell them I own a 82 room, memory care or independent living and a mile away, and I need finance. I'm buying it. I need financing, and banks get credits for loaning back into their community, and it's a win-win for both parties.
Yeah, Eric, I would echo that. I mean, one of the things when we're looking at some of these buildings that are secondary, tertiary markets, I mean, we just Google and see who the local banks are, right?
Yeah.
And that's the ones that, hey, they're oftentimes happy to make a $3 million loan, a $5 million loan.
They don't see those sizes very often, so they're like, "Come on in, you get taken
Right.
out to dinner, go to the local diner."
And another audience question, do any of you think we will start to see stupid money come into the market, or lenders getting way too aggressive?
So for sure, I think borrowers' expectations are always pushing the envelope. I remember pre-COVID, it was not uncommon for, some borrowers to get 105% financing on an acquisition that was losing money. I don't know how anyone ever loaned into that, but people did. I certainly hope not. But I do think that there are always new lenders looking at our space from afar, and they want to come in, and they don't understand the market, and they overlend, and probably wind up getting hurt. I don't know. Haven't been one of those lenders, thankfully, but I do think that dumb money will be coming back in. And I don't think that dumb money is good for anybody, though. Like, I don't think it's good for a borrower to have a lender that doesn't know what they're doing as well. That could turn out really bad for both of them.
Yeah. Yeah, I agree. I mean, I think I kind of hope it doesn't happen in some ways. As a borrower at times, having a lender that's willing to be outside of market. We're not one to take a tremendous amount of leverage, so yeah, I think we would be pushing them on other components, on recourse, on structure, on but yeah, I think it's inevitable as the industry, continues to down the path it's going.
Yeah, that was one silver lining to the capital markets chaos and soaring costs, was it injected some conservatism into pricing, which is not
Yeah.
necessarily a bad thing. It could be a
Well, and I
lesson
think
away.
before we get to the point where there's a bunch of dumb money, I think the probable next step is certainly like amongst the banks, just like a slight loosening of credit policy. I think there's, most bankers are somewhat old school in their view of, recourse is king. And I think as we saw the capital markets really running and call it 2018, 2019, non-recourse bridge loans were available everywhere you looked. And now it's certainly a lot tighter than that. And I think before you have brand new people coming in and doing crazy things, that's probably the next thing to happen, and it probably should happen. I mean, especially as banks try to compete for some of these stabilized loans that they're not going to be able to pry out of Fannie, Freddie, or Lifeco hands. Maybe they look to slightly lower debt yields, and as long as they feel confident with the credit.
Got it. And we just got another audience question. As a broker, I see an increasing number of banks saying that they've been burnt with seniors housing on their balance sheet. Any thoughts on that?
Yeah, I mean, there were a lot of there. You think about just the number of shovels that were put in the ground, and then assets that were delivered into COVID, and if those were with, call it, tourists to our industry, meaning groups that weren't really willing to stand behind the building and figure out a way to solve and kind of slog through COVID and then the inflation that followed. I think there's certainly lenders we talk to all the time that I think are still working through those types of loans and those types of issues. But I don't think that it's as widespread or as much of a concern as generally the industry probably perceives it to be. It
But,
feels
I
like
mean,
now.
I
So
would
go
say
ahead.
Fannie and Freddie got pretty hurt in the whole seniors housing market when rates started going up, right? So,
That's right.
um,
But the burden was very much on the borrowers to maintain, super expensive caps, and
yeah,
um, they fixed that in the interim. But yeah, I mean, they're both still dealing with some legacy issues.
yeah.
Yeah. And Ben, I mean, yes, there are plenty of lenders that uh, you know took some hits, got burned. You know what? There were a lot of lenders in the hotel space that really got burned as well, right? So
And office space too.
and the office, right? Like, on a relative basis, um, those were probably smaller impacts relative to those other asset classes. And so I think that's part of the reason why a lot of lenders have come back so quickly, right?
Yeah.
Ultimately is, yes, they weathered the storm, and the industry is, not back to where it was, right? I mean, we're not at 35% margins, generally speaking. But we're in a pretty good spot and headed in that direction, most likely.
Yeah, and I
And
would say, based on cap rates, right? Assisted memory care for sure, skilled nursing is a lot safer than multifamily. When the multifamily market got hot, cap rates went from 6 to 5 to 4 and even 3 in some places. There's such tight margins. You have a 25 basis point move in rates, and you're underwater. In the skilled space, so you underwrote at a 250 coverage, rates go up 100 basis points. So you're still at a 180. You're still making money, right? You're still covering your debt service. And the same thing with the assisted living space. I mean, not quite as drastic, but when you're underwriting to a 145 or a 150 or 170 coverage, rates go up. you can absorb that. So, again, I think that a lot of people, they get into this space. There are a lot of good lenders in the space that know what they're doing. And, all three of us can probably count them on our hands, both hands, and maybe have 1 foot in there, 10, 15, 20 good lenders in the country. Stick with those. Unless, again, you're in a secondary market, and it's a real relationship thing. But the risk is when you have these uh, lenders who kind of have been on the outside and looking in, and then they jump in and they don't know what they're doing.
Yeah,
Eric,
Eric,
for those lenders that are focused on skilled nursing, how are their views of lending on acquisitions or refinances for skilled nursing facilities? How have they changed in the last 12 months?
So I don't really think that they've changed much at all, right? I mean, obviously, some states on a per bed basis are absolutely nuts. We're seeing, West Virginia pushing $400 a bed, and Virginia now people are asking for $450,000 a bed in value. That's a hard pill for me to swallow, right? But other lenders are okay with it. Obviously, we're looking a lot more at quality of care. We're looking a lot more at other assets, right? Where maybe this asset is has great care and then a good, 3-4 star rating, but we're looking at kind of their global portfolio. We're looking at global cash flows as well. We're trying to get a general health of the overall parent and the overall partners within the company, within the operator, to really see how they're doing across the board, and not just on that specific group of homes that you're looking at, both from a cash flow perspective and a quality of care perspective, because there's a lot more scrutiny now coming down from CMS and staffing ratios, that you don't want a home to slide into the SFF candidate list or SFF list, or potentially even get shut down.
Got it. I'm going to skip a few of the questions because time has flown. So Sarah, I'm going to go to what sectors or deal types do you think are going to see the biggest change in capital costs in 2026, either as a result of increased competition among lenders for those deals, or because spreads are shrinking as a result for those deals? Is it, Class A stabilized? Is it the value add? What do you think?
Well, I mean, real time, we're seeing it certainly compress cap rates for portfolios that are, of newer vintage, performing well, IL, AL memory. I mean, that's very much happening at the moment. I think, so the biggest change of capital cost is probably for the larger loans. At least that's where we're trafficking as well too. So that's kind of my viewpoint. I think, more liquidity certainly in the bridge space has brought in pricing. Like I said, I mean, that's where we've seen that, call it 50 to 75 basis point compression on spreads. I mean, I know that this is a seniors housing and skilled focused call, but I mean, active adult has become, an even bigger focus for a lot of lenders as well. It's become, Nick has obviously made a big push and is focused on increasing awareness for active adult. And I think, that continues to also benefit from improved, conditions from the lenders as well.
And James, same question to you.
yeah, no, I'd agree. I mean, it's hard because they've come in so much across the whole spectrum, but certainly on the Class A stuff, right? Spreads are really low, like Sarah noted. I think in the transitional space, the value add, even the heavy value add, like, one, you couldn't even get a bank to do that sometimes, or even look at it or quote it, right? They didn't want to bring anything that had, net operating losses, right? Like there's like, no, thanks. You can't pay me enough in spread to take that risk. And similar on the bridge lending side, they wouldn't want to take that risk. There were just other opportunities that were better. I think today, not only is their capital there, and debt capital there, but it's at a reasonable spread. I mean, Eric was mentioning, 350, 450, maybe that stuff. If it's, truly debt fund, if you're in that 400, 450 range, like, that might have been 600 over, a couple of years ago, right? That's really come in. And more importantly, SOFR's come down 100 basis points, 125 basis points. So, I think that capital that wasn't there, those deals just wouldn't trade. I think that's where, we'll see a significant movement.
And I agree with both of you. And also over the next couple of years, we're going to have over $18 billion of debt maturing in the seniors housing space. And, we think that that's going to fuel more lower basis deals. And, people are going to be buying at, at discounts, and lenders are going to be taking a haircut. And, also the cost, like, I think there's going to be a big market for some of these sales because the cost to build versus to buy, there's a big gap between them. I think assets trade well below their replacement cost based on all the inflation that's happened over the last couple of years and supply chain issues.
Yeah, James and Sarah, when do you see that kind of build versus buy dynamic switching? Do we need to see more comps of deals that are selling for well above replacement cost? Like, what has to change?
Sarah, I'll let you start.
I think it's more construction cost. I mean, hard costs are going to have to come in. The return profile, I mean, for something, if you're buying something that's more core plus, I mean, that cap rate continues to get lower. But to Eric's point and what James is saying, you can still buy a value add opportunity below replacement cost and hit the same return that you would hit with a development. So I think, for the most part, why would you take on the construction risk to do that? Obviously, we're looking at a pretty big supply demand imbalance over the next couple of years. So I'd love to see more shovels in the ground. It's just, the math isn't there for the equity to justify taking on that risk. The returns aren't there.
Sarah's spot on, right? It's all about the equity here. There are lenders out there that would do construction loans all day long, right? Their basis they're comfortable with, right? They're talking to open a building up 2-3 years from now. So, I mean, I think there are banks out there that would certainly do construction lending. There's really no equity, right? We look at deals all the time, and it's sure, if you're buying something that's 10 years old, it's not the same as being brand new, but the risk you're taking for that just doesn't make any sense. And so, I don't know when that changes, but I don't think it's in 2026. I think you will see sporadic development, right? You see not-for-profits developing, you see sort of for-profit, non-profit partnerships that have formed in order to get development deals off the ground. Again, there's not a lot of those, right? And there's not a lot of sponsors that can pull that off. So, and you see the occasional for-profit development deal that's getting done, but I think it's going to continue to be challenging to get any development done, and good for value add acquisitions and even honestly stabilized Class A portfolios, right? Because you're just going to have pricing power. you're going to have that much more lead time in the markets.
Some dumb money may need to put some shovels in the ground for anything to happen. Eric, you mentioned the kind of potential for some distress coming our way, and that's a part of this case study that you have here. So, want to give you a chance to touch on that.
Yeah. So there were a number of homes in a portfolio that were financed in the Northeast. They were financed with one of the agencies during COVID, and shortly thereafter they defaulted. Rates went up. Actually, I think the cause of the rates going up, defaulted. They were foreclosed upon and put into receivership. And we have a buyer. We haven't closed yet, but we're actively working on this and expect to close on this 5-pack of deals, all independent living. And so it was, the buyer is buying it at well below replacement cost. and they're coming in with a lot of equity. And so the leverage was right. We think we'll be able to, in a year or so, take this back to one of the agencies, and but it'll be totally different ownership and at a much better price point and much lower leverage. So I think a lot of lenders and even people like James and other owner operators are going to see a lot of opportunity like this, and you're going to think, wait, where do I want to deploy my capital, right? I mean, it's going to be rough for the lenders, but it could be great for new money coming in and new owners and developers.
Yeah, Eric, I would say we're seeing some of this. We're buyers of non-performing loans, defaulted loans. You know, we like that space. We bid on deals in receivership. Like that's obviously a heavy value add proposition, but there we frankly expected more of it through COVID.
I think we've all been waiting for the shoe to drop, and it just hasn't quite. We've seen it trickle in a little bit here and there, but I think everyone was thinking, it's going to be this big flood of deals coming to the market. It hasn't happened, I think, because a lot of the lenders are trying to work out, do forbearance,
Yeah.
give breaks, and just restructure the debt, right? And just to keep it alive so that they don't have to sell it at a loss.
Yeah.
Are we going to see more distressed deals in 26 versus 25?
I actually think that probably the worst is behind us. I think, with rates coming down, I think rates, SOFR being high was a big stress on borrowers. I think it was unexpected, and where people got spoiled when rates were a lot lower. And I don't know how low they'll go. We live in a very dynamic time right now, and every day I wake up and I can get like whiplash,
Yeah, is the 10-year treasury still below 4 today? I didn't
It
check.
is.
It is, yeah. At least for this minute, right? You never know what's going on in this world.
Mm-hmm.
Yeah, Ben, I just
James and Sarah, yeah, go ahead, James.
I don't necessarily think we've seen a lot of distress, right? Like actual properties losing money, that haven't traded, that have ended up in receivership. I mean, to the tune of, some receivers have literally over 100 deals that are in receivership. So I think what we may see, right, as valuations have recovered, is we may actually see those deals ultimately trade. Whereas before they've just sort of been sitting in purgatory, and receivers have kind of kept the building sort of just open, operational. Lenders have not pushed to foreclose, have not pushed to actually sell them because the loss would be so significant. And now that capital's back, equity, debt is available, I think maybe we'll see more of those actually trade.
Yeah, I think the investment sales market's going to be quite busy in the coming few years.
Absolutely. We are just at 11, for our Levin Pro database, we have never seen any kind of volume like this as far as deal activity. October is already above 60 deals. And that's already one of the most active months ever. We're probably going to set a monthly record at this point. So, and we haven't even added any deals from potential earnings calls or reports too. So it's incredibly active. No thanks to someone like Sarah and her team at Newmark. So
Thanks, Ben.
It's been keeping us busy.
Yeah.
Sarah, do you see more distress happening in 26 versus 25, or would you agree that we've seen the worst?
Yeah, I agree. I think there's just, given the liquidity in the market now, you can solve it with debt. You can probably solve it by selling it. We're certainly seeing some deals trade somewhere between the debt balance and the seller's basis still. Like those deals are happening, but there's equity for it, and there's a lender on the other side for that buyer now. So less stuck in purgatory, to James's point, and more, actual volume happening.
Yeah. Well, we got an audience question. Why would lenders be taking a discount if values have been rising with census increases?
Because it was over levered when they lent on.
Yeah, their last I mean, and that was what we saw a lot of in 23, which is why you couldn't refi something in 23, was your last dollar was almost like never gonna hit what the new value is. I mean, I think in certain markets where they were so heavily impacted by COVID, you're unfortunately seeing debt balances today still that like you'll be lucky to sell the asset for that. Unfortunately, I mean that those situations exist.
It did not help that our busiest M&A years were 2019 and 2021 when cap rates were at their lowest.
Yeah, and we were LIBOR based, so LIBOR was 25 basis points forever. So that was free.
Yeah. And you mentioned that you have the option of selling, you have the option of refinancing. I'm wondering, is the trend in property values or the trend in maybe more generous terms when you refinance the property, is one outpacing the other when borrowers are faced with that decision? Is it making more sense to sell now versus refinance, or vice versa?
Again, I think it depends on the deal, because in some scenarios, I mean, you can refinance, but it's a cash in refi where you have to pay down the debt balance. There's no way around that. So I mean, we're seeing some scenarios where the equity is just, they're done. They're not going to continue to support ongoing operations or debt service. So they have to sell it. There's situations where they're going to, they feel like if they can get through the next 18 months, whether that's through an operator change or some other kind of fundamental shift at the asset level, they can get through it, then they'll refi. It feels very deal dependent.
Yeah. And James, maybe very briefly, is there anything to add when it comes to mezz debt or pref equity or any other kind of facets of the capital stack?
Yeah, I mean, I would say today, I mean, I've done a lot of mezz, development mezz, kind of AB structures. We're not seeing a huge demand for that. We'll play in that space. We've done that. But right now, frankly, there's just so much equity out there. The cost of mezz, obviously really skyrocketed during COVID, sort of post-COVID. That's a reflection of just where interest rates went, where senior debt interest rates went, right? When you have senior debt at 8, 9, 10%, right? Your mezz is not 13%, right? That just doesn't make sense. So, yeah, I mean, I think right now, we are seeing some lenders, if they want to get more aggressive up the capital stack, they're doing AB type structures. So these are bridge lenders or similar, kind of creating synthetic mezz. Again, on the senior housing side, it's probably topping out at 80%, give or take. On the skilled nursing side, Eric can chime in. I'm guessing that's pushing closer to 85, 90. But not a lot of that going on today. That may change. That may change as senior debt cost of capital comes down and cost of mezz comes down. We may see more of that showing up.
Yeah. Well, I think we've come to our last question at this point. We've covered pretty much every topic that I wanted to, and taken all the audience questions. If any come in the last couple of minutes, then we can go to those. But I want to finish up with some lessons learned from all of the capital markets chaos from the last several years. Maybe some lender lessons, but also some borrower lessons. And I just want to kind of go down the line here. So, James, do you want to kick us off there?
Yeah, I mean, I would say, across our portfolio, we had some assets that did not meet underwriting, to be honest, right? Like, things outside of our control. I would say have a good relationship with your lender, communicate with them. The lenders throughout this last few years were very understanding and willing to work with you. And so, I think hiding things from the lender, surprising lenders, specifically regulated banks, is not the way to go. So I would say, having open lines of communication with your lenders is very important.
James, that's what I was going to say. Borrowers need to manage their lenders. The last thing you want is for a lender to see something in the paper or hear something that happened to your facility and have to call you. If you know something's going on, if you're having an issue, lenders are your partners, right? This is not an us versus you. It's a we thing, and we want the best for you. Your success is our success, and our success is your success. So open communication. And from a lending standpoint, this goes to show that who you lend to is paramount. It's far more important than the asset that you're lending on. These are operating businesses. We need to know who the people what their integrity is, who's running it, versus on like a multifamily, you might be more concerned about the amenities and the appliances and the new kitchens, right? The granite countertops. With healthcare, it's kind of reversed. I mean, obviously you want a nice physical plant, but who you lend to, who your sponsor is far more important.
Yeah, I don't have a ton to add to that. I think there's a lot of people, a lot of owners and operators that are going to be rewarded with really good pricing on deals that they kind of really stuck through and stayed with over the last couple of years. And now that there's liquidity back, they're going to get paid for that. I think there's probably a lot of developers out there having learned the lesson on, overbuilding studios, for example. A lot of what we're seeing, just more nuanced at the asset level. The deals that are struggling were overbuilt with studios or overbuilt with memory care. So I think it's, just being mindful on what you're looking at, and being realistic on underwriting expectations. And then, yeah, I mean, certainly on the borrower lender relationship side, that's extremely important. I don't have too much else to add.
No, well, all very important points though. So, all right. Any other final concluding thoughts? And anything you want our audience to know? Otherwise, I think we can.
No, it's great to chat with everyone, and I feel like this is just so much more upbeat than we probably all would have been even a year ago. So it's good to see the market come back and have this many people want to participate and hear about debt capital markets, which would have been a pretty grim call last year. So
It was good timing for this. We did get one audience question just now. Exiting assets trade well below replacement cost, but do you mean new development cost? An older property should almost always trade below a new one, no?
Not necessarily in our space, right? It's an operating business, right? So it's very possible that, because of the operating nature, it could trade above its replacement value, right? Because you're not leasing it up. The location itself, right? Maybe you're adjacent to a hospital system. I agree with that thought, generally. And yes, but today, like, that delta becomes very wide, and we're looking to, buy at 60% of replacement value and exit at 80% of today's replacement value. And we feel really good about that, right? Hopefully we can exit closer to 90 to 100% of today's replacement value, but that's, those are the type of metrics we like and look at.
Thank you, James. And thank you to all three of you. Sarah, I echo the positivity. This conversation was just jam-packed with, I think, useful information for the audience. So that was fantastic. We covered so many topics, and I thank you all for your preparation for this, the case studies, and bringing such a positive attitude to this. It was a lot of fun. I love all the back and forth between the three of you too. So that was great. And also thank you to New Point for sponsoring today's webinar. It was a pleasure working with you to get this done, and hope to do it again in the future, certainly. So James, Eric, Sarah, thank you so much for joining me today and for all your work.